morning, ladies and gentlemen. On behalf of 12 Capital, I would like to welcome you to our Outlook webinar for the 2024 ILS renewal season. My name is Thomas Frey, and I will guide you through this webinar today together with my two colleagues, Marcel Grandi and Jet Scanlon. Now, as you all know, liquid cat bonds have reached all-time high spreads in recent months. But relatively unnoticed by this, the private ILS market has recovered even more significantly. In this market, yields in the range of 15 to 25% can be achieved, especially in the so-called peak peril region. We are convinced that in context with the decorrelating characteristic of this strategy, an investment can be an ideal building block or addition to a private market portfolio. But very important, and this is our focus today, the 24 renewal season is just beginning. After a challenging 23 renewal season, the reinsurance markets are now preparing for the coming year. Are there any initial indications regarding spreads yet? Can we maintain the current high levels? And important to know, how do we as 12 Capital invest? Do we prefer retrocession trades, quota shares, sidecars, and for what reasons? My colleagues Marcel and Jet will tell you more about these topics in the next 20 to 25 minutes. I will now hand over to my colleagues. First to you, Jet. Jet, what conclusions do you take from the past hurricane season?
Thanks, Thomas. And yeah, welcome everyone to this webinar. We're going to kick off by starting with a review of the 2023 season, so hurricane and insured losses more globally. And yes, when we think about renewals, things like supply demand imbalances, macroeconomic conditions are very important, but actually an assessment of loss experience from the preceding year can materially drive how hard or soft a market may be. And I think an important point to remember is that when we think about how hard a market is, it's not just rate changes, but also terms and conditions, structural changes that we see in the market. And those factors are often driven by events. So for the 2023 hurricane season, going into the season, it was a fairly well documented trade-off between warm sea surface temperatures that are inducive for hurricane activity and the trend towards El Nino environment, which tends to inhibit hurricane activity. And it does appear that we saw that factor play out, where we had an above average number of named storms, but actually what we saw is that the proportion of those storms that made it to major categories, so Cat 3 and above, was about consistent with the long-term average, and that inhibition can partly be explained by wind shear, but other factors that are typically associated with an El Nino environment. The chart we're looking at here. Yes, Thomas.
Just a quick question which coming in. Someone is asking, does El Nino impact other perils such as convective storms or winter storms in the US specifically?
Yes, it's a good question. So I would say firstly, in the Pacific Ocean, in the Eastern Pacific, which we'll come onto in a bit, there's an opposite effect to Atlantic. So where we see El Nino typically decrease Atlantic hurricanes, we have an increase in the Pacific. And yes, El Nino, given it impacts the global weather systems, we do see it has impacts to secondary perils such as thunderstorms, wildfires, winter storms, but those impacts tend to be more regionalized. So a broad assessment is that the southern states tend to have cooler, wetter winters as opposed to the northern states in the US.
Okay, thanks.
And so the chart we're looking at here is the historical El Nino, La Nina trends. And I think one important aspect we need to take into consideration when assessing what phase we're in is actually the strength of the signal. So yes, current forecasts say that El Nino is here to stay through to next year, but that alone is not enough. We need to look at actually how strong the signal is. And we've pulled out a few key years where we've had extremely strong signals. So 2015 and 1997, where we had strong El Nino years. And indeed, these were associated with lower than expected hurricane activity, and vice versa to the 2-year window of 1998 and 1999, where we had a strong La Nina phase, and that was indeed associated with 2 years of increased hurricane activity. Having reviewed the Atlantic season, and the key takeaway was that, yes, while there were many named storms, actually the impact from the Atlantic was fairly minor, with only Idalia causing significant single billion-dollar industry losses. Actually, what we've seen in the Pacific, especially recent, was a very material event, Hurricane Otis. So this event was quite remarkable in the fact that it was off the coast of the Atlantic, off the Pacific, not many miles away from Mexico, and the forecast had it making landfall as a Cat 1. But we saw rapid intensification, and within a day, the storm made landfall as a Category 5 in Mexico, causing damage in the tourist area of Acapulco. Again, what I would say, and Marcel will talk to these points later, is that at 12 we focus on peak peril exposure. So in the ILS space, whether that's cat bond or the top layer private ILS transactions that we invest in, we don't expect that to be a material impact.
All right, there's maybe a good questions already for Marcel. Obviously, annual insured losses exceeding $100 billion a year appear the new reality since a couple of years. Can you underline this?
Yeah, it looks like 100 billion insured losses is a kind of new norm. Also, the last couple of years, it was always above 100 billion. In spite that we did not see, as Chet outlined, a major hurricane affecting the US coast. Interestingly, we believe that all these losses will not the space where we are active, the retrocession market, meaning the reinsurance of reinsurers. However, these losses partly affected the reinsurance market. For instance, if you look at the US convective storms activity, I believe reinsurance companies who are focusing in their strategy on regional players in the US probably had a certain amount of losses, rather than reinsurers more focusing on nationwide or super regional players. And we're also seeing, for instance, that the Turkey earthquake event had a certain impact in the losses of some reinsurers. So it was not, I would say, an overly good year for the reinsurance industry so far. I believe before we go really then to the very interesting parts, our outlook on the renewal, the pricing, and so on, a couple of maybe general points how to classify ILS. Obviously, in ILS, we differentiate between the natural catastrophe ILS and the non-catastrophe one. I mean, natural catastrophe sits around 95%. The non-natural catastrophe, meaning life, cyber, casualty, and others, is probably 5%. And we have covered the non-cat ILS segment in a number of webinars over the last couple of months or weeks. Maybe now come to the next slide, the natural catastrophe part, which is obviously particular of interest. Here we differentiate between public ILS and private ILS. Public ILS, that's obviously the cat bond segment, that is around 50% of the alternative market at all. The private ILS segment, it's the excess of loss part, collateralized reinsurance, the sidecar. Usually private ILS should have a higher volatility, but also higher risk-adjusted return than the public segment. So private ILS should be a notch riskier. If you look at the public ILS market, the average expected loss is probably in the range of 2.5%. The private ILS market we are looking at is in an EL range between 3 and probably 6.5%. And again, our focus is peak natural perils. What we are trying to avoid is, let's say, secondary perils, non-peak perils. So we are not trying to seek diversification in these areas.
2024? What is your forecast?
Yeah, that's, I think, obviously, to make a forecast, one has to look into the past. And what we were seeing, obviously, in 23, there was a tremendous increase of the pricing in retrocession, meaning the reinsurance of reinsurance, but also in reinsurance. So we are conservative, and we think the potential for price increase is probably limited to a certain extent. Our estimate is risk-adjusted price increases between flat and maybe 10%. There is, we believe, more potential for substantial price increases at the middle layer segment, less potential for substantial price increases for the top layer segment or the more risk remote segment, because that is exactly the segment where there appears to be more competition of protection providers. What makes us in a way positive for the future is that reinsurers, and that reflects the retrocession market, are ceding a lot of their exposure to the retrocession market. I think the cession rate is around 16.6%, meaning 16.6% of the premium are ceded into retro. Inflation has an impact, obviously, on the exposure and the insured values, meaning there is a demand to buy a bit more limit. On the other hand, retentions are increasing, meaning that the layers become more risk remote. And also interesting is that retro generally is perceived to be a bit more costly than reinsurance. Hence, attractiveness is deemed to be higher. However, what we also observed in 23 is that the reinsurance pricing was catching up, in particular in the mid-year renewal in the US. So obviously in the retro market, you can obviously only pay as much as you're getting from the reinsurance. And the good reinsurance pricing should also allow, let's say, a maintenance of the high level of retrocession pricing. And what has been said before, it's not only the price what is important, it's only also the more soft factor. The hard market is also influenced by terms and condition. And here we also saw tremendous improvement the last, I would say, 2 years. I guess we have now in all contracts a named natural perils language, meaning we don't have explosion, fire creeping in. And that was particularly the problem you had in the COVID times, because you had a loose language and then COVID-related losses, business interruption losses were creeping in. So everything is nowadays much cleaner. The exclusion list is relatively complete. And in particular for the collateralized market, most important is that you have a very good and clean collateral release and commutation language.
Okay, this sounds good. Marcel, there are a couple of questions coming in. If I may, I will ask you the one or the other of these. The first one is, would you say that public ILS are rather non-proportional, whereas private ILS are more proportional?
No, I mean, the public ILS market or CatMon are always based on excess of loss contract, meaning the liability of the investor or the reinsurer is starting from a relatively high retention level. The private ILS market, if you put it that way, is segmented again in excess of loss contracts, again where the liability is starting from a high retention. I would say excess of loss is probably 50% of the retro market. Then for retro, obviously more important is also the cat bond market, in particular index-linked trades, because retro is not so homogeneous. So reinsurers are going to use index-linked cat bond for protection, obviously with a basis risk. That is maybe 20%. What has lost a bit of relevance for reinsurance company for hedging purposes is ILWs, simply because that index-linked cat bonds are let's say, very competitive, and it's very difficult to get basically excess returns or an illiquidity premium through ILWs. And sidecars obviously are, again, an important pillar of protection for many reinsurance, probably constituting something like 25% of the retrocession buying.
Okay, thank you very much. There's an additional one. Someone is asking, how strongly has pricing held up this year despite the influx of capital of the first half of 23 compared to the post-Irma period?
I mean, yes, I mean, if you look at the cat bond market, cat bonds are always, let's say, the first to react to supply and demand, let's say, changes. And obviously, we had a peak in cat bond pricing 1/1/23, historic peak, incredible good prices. And over the course of 23, I mean, this high pricing level came a bit down, probably by 25-30% from the very peak. And that is also, I would say, a consequence of higher supply from the capital market. I mean, the private ILS is probably a more difficult to react because transactions are one-year transactions. I mean, you're locked in for a year, and the pricing is only in a way determined on an annual basis.
Mm-hmm.
What we want to show here, and that is basically our experience of what we said more in general words of the price increases. I mean, there are different components to evaluate attractiveness of spreads. One is obviously the spread. The other one is the excess spread, meaning the percentage, basically the spread is exceeding the expected loss. Other components are, for instance, the multiple, meaning the spread divided by the expected loss. And what we could observe for our portfolio is obviously that the market development is reflected in our portfolio of retro deals as well. Maybe a point I want to make to Thomas on your comment on the comparison between, let's say, excess of loss retro and proportional retro. I mean, there is a fundamental difference, obviously, in the fact that proportional or sidecars, investors are participating basically from the first dollar loss, but also from the first dollar premium. So I would say in sidecars, there is a higher exposure, obviously, to frequency and attrition than in excess of loss, because in excess of loss, in our understanding, you would probably be at risk if there is a market loss in the US starting from somewhere 55 to 60 billion. Below that, there would be expected no impact. And that's different, obviously, with sidecars, with the frequency component. I mean, here, there is exposure to all the events Chad outlined before, Turkish earthquake, to the severe convective storms in the US. And you also have a bit more exposure to non-peak perils, to so-called diversifier, which are a bit more difficult to model because it's a rule in sidecars. I mean, economics increase with the leverage, and a high leverage can only be achieved with a high diversification. And diversification means basically you are diversifying into, let's say, non-peak or exotic territories.
Mm-hmm. So there's a good reason why we mainly invest into retrocession deals, right?
For us, it makes sense. I will also say, I mean, there are a number also of good sidecars in the market. What I think is also interesting, if we have structured sidecars who, for instance, have their focus only in peak peril territories or invest only in tail layers, in risk remote layers, but that is only the exception. I mean, the general rule in sidecars is really participation from ground up in an entire book or portfolio. And I think we have this graph later on. I mean, the performance or the technical ratio of the reinsurance industry from 2017 on was not so good. And maybe we can show the next chart. Yeah, that's it. I mean, the underwriting return, which is here expressed as the underwriting profit, I1 minus the combined ratio. It has, I mean, the combined ratio has in the high 90s the last 3 years. It has been above 100, meaning negative, from 17 to 2020. I mean, the COVID impact was noticeable. And we believe that this also shows that from the industry as such, I mean, there cannot be an incentive to compromise on rates. I mean, the performance was not in a way excellent the last couple of years. I mean, there is pressure on return on equity, and we're expecting that the market in general will maintain the underwriting discipline on rates, and that should, let's say, keep us positive for the future, that the present high rate level will not be, let's say, the exception of the exception, but rather be also going on in the future. I mean, in the past, the cycles were lasting 2 years. If you look, for instance, after the Tohoku earthquake and the resilient earthquake in 2011, I think we had high rates probably only for 1 year. And then the soft market started again, but that was obviously accompanied with low loss activity, loss ratios in the low 90s. But we believe that the high rating has the potential to be more sustainable in the future.
Okay, there's a question coming in from the audience. Someone is asking if you are able to provide a view on the relative attractiveness of retro and reinsurance pricing and TNC from a capital provider perspective for 24.
Yeah, I mean, our conviction has always been that at least when we shaped our peak peril strategies over 3 years ago, that retro, or at least the risk remote top players in retro, are the most attractive as compared to reinsurance, because retrocession generally has a pickup in rates to reinsurance. I mean, for, let's say, older underwriters, there was a general rule of thumb that retro pricing should always be a two-digit number, even if the expected loss was below 1. It always said, yes, I mean, the retro price should be always above 10. And yeah, we believe that there is obviously certain capital constraints. I mean, there are not as many retro players as there are reinsurance. There are a number of, let's say, committed retro market like a Renaissance Re, Everest Re, and otherwise the ILS market is probably 50% of the protection sellers for retro. And yeah, we believe for us it's the best market to be in.
Then we have some questions from the audience. There's one for Jet. Someone is asking if the rapid intensification of Otis due to warm surface was related to the warm surface temperature, or are there other reasons?
Yeah, that's a good question. So partly is the answer. There was the sea surface temperatures in the Pacific were warmer than average, so it likely played a role. I think also we can point the finger to the El Nino environment, which tends to facilitate storms in the Pacific. And I think maybe a third factor is just some idiosyncratic factors to do with the storm's specifics. So it moved northwards more than was expected and tended to avoid this large amount of wind shear. And there was also a phenomenon called a jet streak, which essentially forced a lot of moisture into the storm and helped it to accelerate. I think probably the key takeaway is that hopefully it can be a case study to forecasters and modeling agencies to capture this in models going forward, if this is likely to become a phenomenon that we see more.
Okay, thank you. Marcel, there's an additional question. This affects more the cat bond side. What is the expectation for how the market will price cat bonds for the remainder of this year and Q1 24? And what factors will impact this?
That's a difficult question. I said before, I mean, cat bonds react, let's say, more on short term to certain supply demand situations. I mean, pricing is supply and demand driven. We have it before. There are different components. There's obviously the loss experience, inflation, general interest environment, market sentiment, and others. I think obviously what is very, very positive in cat bonds, and that's a convincing story, cat bonds, due to their strict language, for instance, performed extraordinarily well in the difficult times between 2017 and 22, as compared, for instance, to the private ILS market. There are certain reasons for it, obviously. Also, I think in cat bonds, one has obviously to pursue a careful underwriting. One has to look carefully into the different type of deals. Interesting enough, for instance, we are seeing right now a number of cat bonds covering, let's say, European sponsors, European risk, be it European windstorm, flood risk or so. Probably a reason for it is that in the traditional market, reinsurers finally try to impose higher rates because Europe has always been a very, very soft market. But my impression is also that cat bond investors are very clever and obviously they're trying to achieve anyway risk-adjusted returns also in this situation where sponsors might come to the cat bond market in preparation of certain capacity shortages in the traditional market. But overall, I'm optimistic, let's say, on the cat bond market, that it will not in a way de-link from the general pricing trend in the traditional market.
Okay.
And there's always differentiation between sponsors. If you have a startup company somewhere in Florida or so, or a company operating in exotic market, I mean, then the price expectation is obviously much, much higher than for established companies with a very long and good track record. Okay. I mean, soft factors definitely will also play a role.
Okay, so we take one last questions and ask you for a short answer. It's about of the hard market you mentioned. I mean, we had a very soft market period between 12 and 17. We are now really in a hard market period. Now rates are skyrocketing. Your opinion, where do we stand in the actual cycle right now?
I think probably last renewal, we started the hard cycle. As said in the past, a hard cycle only lasted for 2 years. Now we think there is a potential to last longer out of the various reasons we mentioned before. And I just also want to make one point, and that's in relation to the, well, that is regarding the relationship cat bond to private ILS. I mean, as I said before, I mean, the soft market cycle we had, and that was also basically accompanied by low issuance activity in cat bonds. So very often, private ILS fund managers had to go to the private market because there was not simply enough cat bond material out in the market. And that obviously the drive in a way accelerated basically the soft market, because then soft market structure as low attaching aggregates, top and drop, were offered, and very often the private market investor had to accept these type of weak structures, and that is not the case anymore. I mean, we are seeing enough very interesting cat bonds in the market. So in a way, markets really have the options, I mean, to select between cat bonds and private market to make the best choice regardless of the instrument. And that is, I believe, is also a very big difference to the soft market we had before 2017.
Thank you, Marcel. Thank you, Chet. Maybe at the end, just a short summary from my side. I think we should emphasize once again that we are currently at a very high premium level in the private ILS sector. If you include the interest income on the collateral, you can currently achieve 20 to 25% plus gross in US dollars. We cannot say whether this level will remain over the coming years, but in the current situation, I believe such an investment is certainly a good alternative or addition to private market portfolios. Now, before I close the call, I would like to thank, on behalf of 12 Capital, all participants who took part in one of our webinars this year. We look forward to your participation, of course, again in 2024. Thank you very much for your participation today. Have a good start into a hopefully more peaceful 2024. Best wishes from Zurich. Hope to see you again. Bye-bye.